When investors think about the most critical companies in the world today, Taiwan Semiconductor Manufacturing Company or TSMC often comes to mind. It is the backbone of modern technology, producing the chips that power everything from smartphones to artificial intelligence data centers. In this analysis, I'll explain why TSMC is not only a global leader but also a compelling investment right now. We will look at its financial performance, business model, technology leadership, growth opportunities, valuation, and the risks that investors should keep in mind. TSMC pioneered the pure play foundry model, which means it manufactures chips designed by other companies but does not compete in chip design itself. This approach has allowed it to partner with the biggest names in technology, including Apple, Nvidia, AMD, Qualcomm, Amazon, and Google. By focusing entirely on manufacturing, TSMC has built unmatched expertise, scale, and trust with its customers. The results of this model speak for themselves. TSMC commands around 67 to 70% market share in advanced semiconductor foundry services. Its closest competitor, Samsung, holds less than 10%, and other foundries like Intel Foundry Services, Global Foundries, and SMIC lag far behind. This dominance is not just about size, it also reflects TSMC's superior yields, cutting edge process technologies, and ability to deliver chips at scale. So let's begin with the numbers because they tell a very strong story. In the second quarter of 2025, TSMC reported revenue of about 30.1 billion US dollars, a 44% increase compared to the same quarter last year. Net income surged more than 60% year over year, reaching nearly 400 billion Taiwan dollars or about 12.3 billion US dollars. Earnings per share came in at 15.36 Taiwan dollars, up from 9.56 a year earlier. Gross margins remained very healthy at 58.6%, while operating margins improved to 49.6%. Return on equity stood at a remarkable 34.8%. These are outstanding levels of profitability, especially in a sector as capital intensive as semiconductors. TSMC also generated about 16 billion US dollars in cash from operations in the quarter, with free cash flow of nearly 6.4 billion US dollars. Its balance sheet is strong, with cash and marketable securities of roughly 90 billion US dollars, giving the company ample flexibility to fund future expansion while rewarding shareholders with dividends. Looking ahead, management guided for third quarter 2025 revenue between 31.8 and 33 billion dollars. This implies nearly 40% growth year over year. This guidance underscores strong demand for its leading edge technologies, particularly at the 3 nanometer and 5 nanometer nodes. The growth story is powered by advanced nodes. In the second quarter, 3 nanometer technology contributed 24% of wafer revenue, 5 nanometer contributed 36%, and 7 nanometer added another 14%. Altogether, nodes below 7 nanometers now make up 74% of TSMC's wafer revenue. By platform, high performance computing, which includes data centers and AI workloads, accounted for 60% of revenue. Smartphones made up 27%, while automotive and IoT each contributed about 5%. This mix shows how important AI and cloud computing have become to TSMC's growth. This far outweighs its once heavy reliance on smartphones. Demand for AI accelerators is particularly explosive. Management expects AI related revenue to double by 2025, with a compounded annual growth rate in the mid 40s through 2029. The rise of sovereign AI initiatives, where governments build their own AI infrastructure, is adding another layer of demand. Simply put, more AI workloads mean more silicon, and TSMC is the only company capable of producing this technology at scale. TSMC's biggest competitive advantage is its technology leadership. The company consistently stays ahead of the rivals in process technology, Its 3 nanometer node is already in mass production with 2 nanometers scheduled for volume production in second half of 2025. Extensions to the 2 nanometer process node like N2P and A16 are planned for 2026. These are refinements of TSMC's 2 nanometer technology. N2P focuses on better performance and power efficiency while A16 introduces a new power delivery system that pushes speed and energy savings even further, making it especially valuable for AI and high performance computing. This roadmap is critical because customers like Nvidia, Apple, and AMD rely on TSMC to produce their most advanced chips. Competitors like Samsung and Intel have struggled with yields and delays, while TSMC consistently delivers high yields of around 90% at leading nodes. In chip manufacturing, yield refers to the percentage of chips on a wafer that actually work. So a higher yield means fewer defects and lower costs. Delays, on the other hand, mean rivals are late in bringing new technologies into mass production, which often causes customers to lose confidence. That reliability is why major clients, including Google and Qualcomm, have switched orders from Samsung to TSMC. On top of process technology, TSMC is also leading in advanced packaging. Technologies like COWS, which allow multiple chips to be packaged together for higher performance, are in extremely tight supply. TSMC is rapidly expanding this capacity to support AI demand, which is set to remain strong for years to come. While Taiwan remains the company's home base, TSMC is aggressively expanding globally to meet demand and to reduce geopolitical risk. In the United States, it has announced a $165 billion investment in 6 advanced wafer fabs in Arizona, along with 2 packaging fabs and a major R&D center. The first fab, producing 4 nanometer chips, entered high volume production in late 2024. The second, focused on 3 nanometer, is already built and may start sooner than planned due to customer demand. The third fab, which will handle 2 nanometer, is under construction. By the end of the decade, around 30% of TSMC's 2 nanometer and more advanced capacity will be located in the US. In Japan, its Kumamoto fab started production in 2024 with another specialty fab planned. In Germany, TSMC is building a specialty fab in Dresden with strong government support. Back home in Taiwan, it continues to expand with 11 new wafer fabs and multiple packaging facilities over the next several years. This global footprint ensures that TSMC can support customer needs while diversifying its manufacturing base. It also secures exemptions from tariffs in key markets such as the United States, where companies that build domestically are shielded from import tariffs. TSMC's scale and efficiency create a formidable moat. Its massive revenue base allows it to spend nearly $7.5 billion annually on R&D, or about 7 to 10% of revenue. This spending power makes it very difficult for smaller competitors to keep up. Its operating scale also provides cost advantages. Even though TSMC's fabs in the US cost 10 to 20% more to run than those in Taiwan, mainly because of higher labor expenses, construction costs, and utility bills, the company has the pricing power to pass on these higher costs to its customers. This matters because most chip makers don't have a choice. They need TSMC's advanced technology and reliable yields, and alternatives like Samsung or Intel can't consistently match that level of performance. In other words, TSMC's unique position lets it maintain profitability even when operating in higher cost regions. In terms of market share, TSMC widened its lead in 2024, reaching more than 64%. Rivals like Samsung lost ground due to yield issues, and Intel delayed its most advanced nodes until at least 2026. UMC, Global Foundries, and others are not even attempting nodes below 10 nanometers. This leaves TSMC as the only trusted foundry at the bleeding edge of technology. One of the most surprising aspects of TSMC is that despite its dominance and strong growth, the stock still trades at a very reasonable valuation. As of late 2025, the TSMC's market capitalization is about $985 billion. Over the last 12 months, it generated 116, that is $116 billion in revenue and 49 billion in net income. That gives it a price to sales ratio of 8.5 times and a price to earnings ratio of around 20. For context, these multiples are roughly in line with TSMC's historical averages and significantly below many other technology leaders such as Nvidia, AMD, and even mega cap firms like Alphabet and Microsoft, which often trade at forward PE multiples in the high 20s to 30s. Its forward PEG ratio is about 1.1, while the broader technology sector average sits closer to 2.0. Price to cash flow for TSMC is just 13 compared with many peers in the semiconductor and AI ecosystem, Nvidia, AMD, Broadcom, and Qualcomm, which often trade at price to cash flow ratios in the high teens or even about 20. This relative discount is striking because TSMC actually supplies many of these very companies with higher valuations with their most advanced chips. Analysts expect TSMC's earnings to grow 12% in 2026 and nearly 20% in 2027. Paying 20 times earnings for that kind of growth looks highly attractive when compared to sector peers, where similar or lower growth is priced at far higher multiples. Another factor to consider is share count. Unlike many US technology firms that dilute shareholders heavily with stock based compensation, TSMC has kept its share count stable for over a decade. This discipline means that growth in earnings flows directly to shareholders without being offset by dilution. Of course, no investment is without risks. For TSMC, the biggest one is geopolitical. Its main facilities are located in Taiwan, which China has repeatedly claimed as its own. An invasion or blockade would be devastating not just for TSMC but for the entire global economy. While most analysts see the risk of military action in the near term as relatively low, it cannot be ignored. Another risk is the cyclicality of semiconductor industry. Demand tends to rise and fall in waves. AI demand has created a powerful tailwind, but history suggests that there will be downturns along the way. Investors should be prepared for volatility in the stock price even if the long-term story remains intact. Finally, overseas expansion comes with higher costs. Chips produced in Arizona, for instance, are estimated to be 5 to 20% more expensive than those made in Taiwan. However, TSMC has enough pricing power to offset these costs, and its global diversification helps mitigate supply chain and tariff risks. When you put it all together, TSMC emerges as one of the clearest long term investment opportunities in the market today. It dominates the semiconductor foundry industry with unmatched scale, cutting edge technology, and deep customer relationships. Its financial performance is stellar with strong revenue growth, high margins, and robust cash flows. The company is at the very center of the AI revolution, supplying the chips that power data centers, smartphones, and next generation computing. Its global expansion ensures that it will remain essential to customers worldwide while reducing some of the geopolitical concentration risks. Most importantly, the stock trades at valuations that are reasonable relative to its growth prospects. With a stable share count, high return on equity, and strong growth outlook, investors are well positioned to benefit from TSMC's success. Yes, there are risks, particularly around geopolitics and industry cycles. But for long term investors willing to look past short term volatility, TSMC offers the rare combination of scale, profitability, growth, and reasonable valuation. In short, TSMC is not just another semiconductor company, it is the most important chip maker in the world, and its stock looks like a great buy for investors today. Thanks for watching. Have a great day.